Hello everyone, today we are going to discuss about HRA, Human Resource Accounting, Inflation Accounting and Environmental Accounting. First of all, start with Human Resource Accounting, HRA. What is Human Resource Accounting? Think of this way, when a company buys a machine, it shows up, it shows up on the balance sheet as an asset, right? But what about the employee who operate that machine? Traditional accounting treats employee salaries as an expense that just disappear. HRA says, wait, employees are actually valuable assets too, and we should measure and report their value in our financial statements. So, HRA is essentially the process of identifying, measuring, and reporting the value of human resources, treating your employees as an asset rather than just a cost. Why do we need HRA? The four key objectives. Very first, valuation of human assets. We want to put a financial number on what our employees are worth to the organization, just like we value our buildings and equipment. Second, better decision making. When managers know the actual value of their human resources, they can make smarter decisions about hiring, training, promotion, and retention strategies. Third, performance evaluation. HRA helps us assess whether our HR policies are actually working. Are our training programs giving a good returns? Is our recruitment strategies cost effective? The fourth, investors information. Stakeholders and investors want transparency. They want to know the true value of the company, including its human capital. Why is it is so important? The need for HRA. Here is the problem with conventional accounting. It's completely ignore the value of human assets. Imagine two identical company. Company A has highly skilled, experienced employee, while company B has average employee. Traditional accounting would shows them as having the same value if their physical assets are similar. That's clearly not realistic. HRA reveals true profitability by accounting for human capital costs and contributions. It brings enhanced transparency to HR spendings and outcome and supports capital budgeting decisions when companies are deciding how much to invest in their people. Remember for your exam, HRA bridges the gap between what traditional accounting shows and what the company is actually worth when you include the value of its human resources. The limitations of HRA. First, lacks of standard methods. Unlike depreciation of fixed assets, where we have clear methods, there is no universally accepted ways to value human assets. Different companies might use completely different approaches, making comparison difficult. Second, employees' resistance. This is sensitive issue. Imagine if your company suddenly announced they are putting a monetary value on you as an employee. Many people find this dehumanizing and unethical. Employees might resist being treated like commodities. Third, qualitative factor. How do you put a rupee value on creativity, loyalty, team spirit, or leadership qualities? These soft skills are incredibly valuable but nearly impossible to quantify accurately. The fourth, non recognition by any standards. This is crucial for your exam. Neither GAAP, that is Generally Accepted Accounting Principle, nor IFRS, International Financial Reporting Standards, officially recognize HRA. So companies can't use it in their official financial statements for regulatory purpose. Methods of HRA. Very first, cost-based model, capitalization of historical cost model. Think of this like buying a machine. When you recruit an employee, you spend money on recruitment, selection, training, and development. Instead of treating this as immediate expense, this model says let's treat them as a capital investment and spread the cost over the employee's expected work life. For example, if you spend rupees 50,000 training an employee and expect them to work for the 5 years, you would choose 10,000 as annual amortization. The limitations of this method ignores future potential. What if the employee gets promoted or become more skilled? It also assumes fixed tenure, but people might leave early or stay longer. The second, that is replacement cost model. This asks what would it cost to us to replace it employee today. Very first, individual replacement cost to replace a specific person like your star salesperson. Positional replacement cost to fill a job position regardless of who currently holds it. The limitations, this doesn't work well for highly specialized roles where replacement might be impossible. It also ignores institutional knowledge. An employee who has been with the company for 10 years knows things that a new hire simply won't. Third, opportunity cost model. This is about foregone alternatives. If you assign your best manager to project A instead of project B, what's the opportunity cost? Major limitations of this, as this only work for the key personnel. You can't apply it to every employee in the organization. For UGC NET, remember these three cost-based model and their key limitations. Question often asks you to compare these methods or identify which is the most suitable for different situations. Let's discuss these three models in detail. Replacement cost model, a detailed analysis. Remember, this model asks what would it cost to replace this employee right now at the current market rate. Two types of replacement cost. First, individual replacement cost. This measures the cost of replacing a specific employee with someone of similar talent and capabilities. For example, your company's head of marketing has unique skills and 15 years of experience. Individual replacement cost would include recruitment cost, that is advertising, selection cost, interview, assessment, training cost for the new person, lost productivity during the transition period. Second, positional replacement cost. This calculates the cost to fill a specific job position regardless of who currently holds it. For example, the cost to fill marketing manager positions, focusing on the role requirement, not the individual person's unique qualities. The key limitations of replacement cost model. It is impractical for a specialized role. How do you replace a brilliant R&D scientist or a CEO with 20 years of experience of the company's specific knowledge? Some skills are simply irreplaceable. Ignores institutional knowledge. A 10 years employee knows your company culture, client relations, internal processes. A replacement might have similar technical skills but lacks the invaluable institutional memory. Doesn't consider loyalty. Long-term employees often have emotional attachment and loyalty that new hires won't have initially. Let's talk about the opportunity cost model, the alternative use approach. This model is based on the economic opportunity cost principle, the value of the best alternative foregone. How it works: when you assign your best project manager to project A instead of project B, the opportunity cost is value that could have been generated from the project B. For example, your star sales manager could either lead the north region expected profit 50 lakhs or south region expected profit 40 lakh. If assigned to north, the opportunity cost is 40 lakh. This 40 lakh represent part of the manager's value to the organization. Major limitations: limited applicability. This model primarily applies only to the key personnel, senior manager, specialists, or employees with unique skills where alternatives assignments are meaningful. While limited applicability for routine job, there may not be significant alternative uses. Difficult to quantify opportunity cost for all the employee. Require detailed knowledge of alternative profit potentials. Hard to apply consistently across the organization. For UGC NET preparation, remember this key point: replacement cost is current market cost to replace. Opportunity cost is value of the best alternative use foregone. Both have significant practical limitations. Replacement cost works better for standard role. Opportunity cost works only for the key personnel. Exam tip question often asks you to identify which model is suitable for different scenarios. Think about the nature of the job and employee when choosing between this model. Critical understanding: these cost-based models are easier to calculate than value-based model, but they don't capture the full economic value an employee brings to the organization. Let's talk about the value-based models. Focus on the future potential. Unlike cost-based model that look at what we have already spent, value-based models ask what will this employee contributes in the future. Key distinction for UGC NET aspirants: cost-based model is what we have invested and value-based model what we expected to get back. Present value of future earning model. This is like valuing a bond or investment. Here is how it's work. Step number 1: estimate future earnings. Project what the employee will earn throughout their tenure with the organization. Second, discount to present value. Use a discount rate to calculate what those future earnings are worth today. Example for clarity: if an employee will earn rupees 5 lakh annually for the next 10 years and our discounting rate is 10%, we calculate the present value of this stream of earning. Key limitations: ignores role changes. What if they get promoted? Doesn't account for early resignation. Focuses only on salary, not the employee's total contribution to the company's profitability. Second, reward valuation model, Flamholtz model. This is the most comprehensive but complex model. Named after Eric Flamholtz, it's considered future services. What services will this employee provide? Key factor: likelihood of promotion, career progression part, retention, profitability. Complex forecasting uses probability assumptions about various careers outcome. Why it's complex? You need to estimate probabilities for different scenarios. Will they get promoted? Will they stay? Will they move department? The third one, valuation on group basis. Sometimes individual valuation is impractical, so we value groups or department as a whole. When it's useful, large organization with many similar employees, when individual differences aren't significant for departmental performance evaluation. If we talk about the limitations, lacks precision for individual contribution, ignore individual productivity differences, can't guide individual HR decisions effectively. For your UGC NET preparation, common exam questions may ask comparison: which model is most suitable? Why is the Flamholtz model considered most comprehensive but difficult to implement? Pro tip: value based models are theoretically superior because they focus on future benefit, but they are harder to implement due to forecasting challenges and subjective assumption. The trend in the modern HRA is moving towards these value based approaches, especially as the companies recognize that human capital is often their most valuable assets. Let's move to inflation accounting. What is inflation accounting? Inflation accounting adjusts financial statements to reflect money's changing purchasing power, keeping value realistic in times of rising prices. Think about it this way: if you bought a machine for rupees 1 lakh for 5 years ago, it is fair to still show it at historical cost when similar machines now cost rupees 1.5 lakh due to inflation. Inflation accounting says no. The core problem with traditional accounting: historical cost assumption. Traditional accounting assumes stable currency value over time, but inflation invalidates this assumption completely. The three major issues: first, overstated profits. When we calculate depreciation based on the old historical cost, our reported profit appear artificially high. For example, machine bought for 1 lakh, annual depreciation 10,000, but replacement cost is now 1.5 lakh. So realistic depreciation should be 15,000 per year. The 5,000 differences inflates our profit. Understated assets. Rising price means our balance sheet shows assets at unrealistically low value compared to the current worth. Misleading data. This creates false information that misleads investors. Investors think the company is more profitable than it really is. It's mislead the tax authorities. They collect taxes on inflated profit, and the management. They make decisions based on the unrealistic financial data. Let's talk about the key insights. Why inflation accounting is needed. Three critical purposes. First, reflects true assets value, shows what assets are actually worth in today's money, not what they cost years ago. Shows real profitability after adjusting for inflation. You see genuine profit, not the artificial profit created by using outdated costs. Ensure capital maintenance. Helps ensure the company maintains its real capital value, not just nominal capital. Technique used in inflation accounting. First, CPP, that is current purchasing power, uses general price index to adjust all the financial statements item. CCA, current cost accounting, uses replacement cost instead of historical cost. Other methods are partial adjustment, reserve methods, and disclosure notes. The limitations of inflation accounting are: first, calculation complexity. The mathematical adjustment can be quite complex and time consuming. No global standard. Unlike regular accounting, there is no universally accepted standards for inflation accounting. Index reliance. The accuracy depends heavily on the price indices used, which may not reflect specific industry conditions. For UGC net preparation, the key points to remember: inflation accounting corrects the unrealistic assumption of stable currency. It's prevent overstating profits and understating assets. Essential for realistic financial reporting in inflationary environment. Methods include CPP and CCA approaches. Exam tip: question often asked about need for inflation accounting and its impact on financial statement. Focus on how it provides more realistic financial information compared to historical cost accounting. Remember, this topic is crucial because most economics experience some level of inflation, making traditional historical cost accounting increasingly unrealistic over time. Let's move to environmental accounting. What is environmental accounting? Environmental accounting integrates ecological costs into financial system. It's evaluate business activities, environmental impact for sustainable reporting. Think of it this way: when a factory produces goods, it also produces pollution, uses natural resources, and impacts the ecosystem. Traditional accounting ignores these environmental costs. Environmental accounting says, let's measure and report these impacts too. The key objective: first, assess and control eco costs, identify and measures the true environmental cost of business operations, pollution cleanup, resource depletion, waste management. Inform sustainable decisions, provide data to help management make environmentally responsible business decisions, comply with green laws, meet increasing regulatory requirement for environmental reporting and compliance. Fourth, improve eco-efficiency. Find ways to reduce environmental impact while maintaining or improving profitability. Core advantages: why companies adopt it. Very first, promotes eco-friendly practices. When you measure environmental costs, you naturally start looking for ways to reduce them. Aids risk management helps identify and manage environmental risks before they become completely problems or legal issues. Enhances company reputation, demonstrates corporate social responsibility, improving brand image and stakeholders' trust. Attracts ethical investors, ESG, environmental, social, governance, investing in growing rapidly. Environmental accounting helps attract these investors. Main challenges: first, lacks clear standards. Unlike financial accounting, there are no universally accepted standards for environmental accounting. Hard to quantify impacts. How do you put a monetary value on air pollution, biodiversity city loss, or climate change impact? Very challenging, right? Data availability issue. Environmental data is often difficult to collect, measure, and verify accurately. High implementation cost. Setting up systems to track and measure environmental impact requires significant investments. Let's talk about the forms of environmental accounting. Very first, environmental financial accounting is record direct environmental costs that impact the company's financial positions. For example, pollution control equipments, environmental fines, cleanup costs. Supports accurate external reporting for stakeholders, shows up in the company's financial statement. Second, environmental national accounting, that is green accounting. This is macro level accounting at the national level. Adjust national economics indicators like GDP, accounts for environmental degradation and natural resources depletion, gives a more realistic picture of nation's true economic progress. For UGC net preparation, key distinction to remember: environmental financial accounting is company level, affects financial statement. Environmental national accounting is a country level and adjusts national economic indicators. Important points: first, growing importance due to climate change concern. Second, regulatory pressure increasing globally. Third, investors' demand for ESG reporting. Fourth, challenges in standardization and measurement. Let's talk about the exam tip. Question often focus on the objectives and challenges. Understand the difference between the two forms. Know why it's becoming increasingly important in modern business. Be prepared to discuss advantages and limitations. Contemporary relevance. This topic is extremely current given global focus on sustainability, climate change, and corporate responsibility. Expect more questions on this in future UGC NET examination. Let's that conclude our detailed coverage of these three important accounting topics for UGC NET Commerce. Quick recap for revision: HRA, valuing employees as an assets using cost-based and value-based model. Inflation accounting, adjusts financial statements for changing purchasing power. Environmental accounting, integrating ecological costs into financial reporting. These are contemporary issues in accounting that frequently appear in UGC NET questions. Make sure you understand not just the concept but also their practical applications and limitations. For your exam preparations, understand the need for inflation accounting in inflationary economies. HRA valuation model knows the growing importance of environmental accounting in sustainable business. Don't forget to like this video if it helps clarify this concept. Share it with the fellow UGC NET aspirants and subscribe for more commerce topic. Your supports help us create more quality educational content. Best of luck for your UGC NET examinations. Thanks once again.